Hello and welcome to AI Market News by LM. All right, let's dive right into a headline that's been shaking up the financial world. We're talking about China, US debt, and the big question, is the dollar's reign coming to an end? Let's get into it.
So yeah, this is the question on literally every investor's mind right now. It all kicked off with these reports surfacing that Chinese regulators are, urging their banks to maybe cut back on their US Treasury holdings.
Okay, let's break down what's causing all this alarm. What's the actual story here? Based on the prepared resources, it seems to be a major development with some pretty huge potential implications.
So here's the deal. We're hearing that in just the last few weeks, regulators have been quietly telling their biggest financial institutions to scale back. And the reasons they're giving? Well, they're talking about things like concentration risk, not putting all your eggs in one basket, and just general market volatility. But the really interesting part? They've got their eyes glued on the potential fiscal shifts coming from the new leadership at the Fed.
But hold on. Before we all start thinking the dollar's dominance is over, we've got to look at the actual data. And let me tell you, it tells a much more nuanced story than the scary headlines.
Okay, first up, this number, $370 billion. That is the total amount of US dollar bonds held by China's big four lenders. I mean, that sounds like a massive number, and it is, no doubt about it.
Right, but here's where it gets really interesting. That $370 billion, it only represents 1.5% of their total assets. Just 1.5%. So when we look at the whole picture, the direct impact is, well, pretty insignificant actually.
And check this out. This isn't some sudden panicked dump. Not at all. It's actually the continuation of a strategic reduction that's been going on for over a decade now. China's holdings peaked way back in 2017, and since then, they've been slowly, gradually trimming them down. We're now back to levels we haven't seen since 2008. So, this is a long game.
Okay, so now let's move on to the market's immediate response. How did this news actually land? What happened when the traders and the algos got a hold of this story?
Well, the initial news caused a pretty predictable shockwave, especially in the Forex markets. It was a classic knee-jerk reaction, you could say.
And we can really see the story in the charts here. The dollar took an immediate hit, right? It dipped, and we saw the yen strengthen as traders just reacted to those headlines. It was a fast and clear move.
But here's the interesting thing. Despite all that action in the currency markets, the reaction in US stocks, and get this, even the bond market itself, was much more muted. Wall Street showed a lot of resilience, actually. The S&P 500 and the NASDAQ rallied, led by tech. And the US Treasury market? It saw a tiny wobble, just a 3 basis point spike, but it stabilized really quickly. It kind of suggests that traders weren't hitting the panic button just yet.
So this is the crucial point, right? This isn't just about one news event. It connects to two much larger structural shifts in the global economy, and we have to talk about them to really get what's going on.
First up, there's this long-term trend of de-dollarization. This is the idea that, over time, countries are gradually reducing their reliance on the US dollar as the go-to reserve currency and for international trade. It's happening as the US share of global GDP declines and, geopolitical alignments start to shift.
Yeah, and as one analyst from Macquarie Group put it, this move is another clear sign that this gradual shift away from the dollar, well, it's a real, long-term development. It's not just a fantasy.
The second major factor here is all the uncertainty around the US Federal Reserve. Specifically, the market is bracing for the incoming, more hawkish Fed chair Kevin Warsh and his plans to shrink the Fed's massive balance sheet. I mean, that balance sheet is a key focus for markets right now, and the idea of shrinking it is a big deal.
So, how do we get a read on what the market is thinking? Well, to understand that, we can look at professional tools like the CME FedWatch tool. This thing is pretty cool. It basically analyzes futures prices to figure out the probability of what the Fed's going to do with interest rates next. It's a great way to see what traders are actually betting on.
Okay, so with all that context in mind, what are the key events we should be watching? What's going to tell us where this story goes next?
Well, as we can see from the information from investing.com, we've got a whole slate of crucial US economic reports coming up this week. We're talking retail sales, we're talking jobs data, and of course, the big one, the Consumer Price Index, or CPI, for inflation.
The market is watching these numbers like a hawk. Why? Because the results are going to heavily influence the Fed's path forward. They could either accelerate or slow down the very trends we've just been talking about, so yeah, they're a pretty big deal.
And that really leaves us with a final thought to chew on. China's move, It may just be a tremor, not a full-blown earthquake. But it makes us ask, is the ground beneath the dollar's dominance starting to shift for good?
Okay, just a brief disclaimer before we wrap up. This video is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion.
Thanks so much for watching. If you got some value out of this, don't forget to hit that like button and subscribe for more.